Okay, so first of all, I'd like to welcome all of you to join the asset pricing session, the International Macro Money and Banking Program. I'm Il-Hyuk Shim, head of the Economics and Financial Markets for Asia Pacific at the Bank for International Settlements. I'm very happy to chair the session. And the session has two papers. The first one is local currency bond returns, foreign investors, and portfolio flows in emerging markets by Giorgio Valente, Inhwan, and Jason Wu. The second paper is a parallel digital currencies and sticky prices by Tao Junxie and Harold Ulrich. So we have two papers. Each paper will have 45 minutes in total. And the paper's presentation itself will be around 15 minutes or so. Then you'll expect about 15 minutes discussion remarks. Then I'll open the floor for questions and answers. So each paper 45 minutes. So let me just move on to the first paper on local currency bond returns for investors and portfolio flows in emerging markets. So presenter will be Giorgio Valente. Giorgio is the head of the Hong Kong Institute for Monetary and Financial Research, and he's also ABFER. So Giorgio, the floor is yours.
Thank you very much, Il-Hyuk, for the kind presentation. And before I start the presentation, I would like to thank the organizers for allowing us the paper into program and giving us the opportunity to present these preliminary results. This is a joint work with Jason Wu at the Federal Reserve Board and Inhwan that is here in the audience at the Bank of Korea. Given that all of us are affiliated with central banks, we would like to use the usual disclaimer, given that the views are our own and not the ones of our affiliating institutions. Okay, let me start the presentation by discussing a couple of stylized facts that we took seriously in order to motivate the analysis that follows during this presentation and in our study. So we first look at the fact that emerging economies, especially in the last decade or so, have been issuing substantial local currency sovereign debt. This is one of the facts that has been already debated in policy literature, also in academic literature, but we took that as a starting point for our analysis. We also look at the fact that local currency bonds are also held in portfolio of foreign institutional investors. It's an important stylized fact because we will use this ingredient thoroughly in our analysis. And finally, the fact that, which is an ongoing debate still in the policy and academic arena, of the fact that portfolio flows to and from emerging economies exert important effects on local currency bond prices and asset prices in general. So against this backdrop, let's try to understand what the contribution we are proposing here is. So first of all, we adopt an asset pricing perspective. So we propose an empirical investigation of an empirical asset pricing model that ties together local currency bond returns in US dollar, foreign investor portfolio returns, again in US dollars. So as you might appreciate, we're not going to touch upon the issue of exchange rate in this version of the study, and also portfolio flows to and from emerging economies. So what are the questions that we aim at addressing? So the major question we aim at addressing are, first of all, whether or not the performance of foreign investor portfolios affect local currency bond returns, and so how? And do portfolio flows to and from emerging economies affect local currency bond returns? And are there any risk premia associated with the point 1 and 2 in this slide? And if so, how and why they change over time? So those are pretty ambitious questions, but we try to propose a very simple model that allow us to address most of those issues. So just to give you a preview of the results, we find that bonds whose returns positively covary with the returns of foreign investor portfolios exhibit higher average return adjusted for market risk. We take that as an evidence for risk premia that there are compensation for what we label active fund risk. So bear with me because I will explain this notion just in a minute. Then the second result is the portfolio outflows from emerging economies positively impact on this price of active fund risk, and bonds with a high average return exhibit high exposure to active fund risk when the price of this risk is high, generating a sort of double effect. So this is an interesting finding because it has not been seen, at least to the best of our knowledge in the literature, and is important to elaborate on it. So in the interest of time, I will skip the references to the literature, but just for your own information, there are 4 groups of major streams of literature we actually took into account in formulating the empirical and looking at the theoretical framework adopted in this paper. So let's start with the theoretical framework first, which is an important starting point in understanding everything that follows in this presentation. So we start with a paper by Vallanos and Woolley in 2013 in Review of Financial Studies. That's an interesting paper for us because it shows that under certain circumstances, returns on risky assets can be seen as a compensation for 2 specific sources of risk. One is market risk, which is the conventional way of thinking, if you wish. And then you have this additional source of risk, which they label active fund risk. So let's try to understand exactly how this active fund risk and where does it originate. So the idea of that paper is to consider the potential in an economy to invest in 2 sources or 2 potential assets. One is a passive market index, and the other one is essentially a fund that is actively investing in different kinds of risky securities. So the aspect that Vallanos and Woolley highlight is that when there is a shock affecting the value of some assets for which the active fund is investing in, these assets obviously will experience a low return in the same way that the active fund will do. And this will trigger outflows from the fund that will have to liquidate some of the assets themselves in order to proceed with the payments. And this outflow forces the liquidation of these assets to experience even further price depreciation. So this situation indicates that when there is an exposure to those assets, they may be further liquidated by the active fund. These assets will have to bear, I would say, a higher expected return for the possibility of facing a large price depreciation. Another interesting ingredient of the Vallanos and Woolley model is that the price of risk associated with this active fund source is indeed time varying, it's changing over time, and is a function of these fund outflows. So if you see, this element is important because there is a sort of mutually reinforcing effect that when there are price effects due to asset liquidations, the quantity of risk will increase, but at the same time, the price of risk will increase too, generating a double effect on the prices of assets. This in turn will generate a much higher expected return for investors to hold these assets in their portfolios. So starting from this theoretical rationale, we try to build upon this framework in order to make it applicable to the context of local currency bonds. And I will spare you the technical details and go straight into the formula of reference, but I will certainly encourage you to look at the details in the paper for further references. So the important part here is building upon the Vallanos and Woolley framework, we obtain an expected return beta representation of excess returns, which is the one indicated here in equation 1. And what we have there is on the left-hand side, we have the expected returns on US dollar excess returns on local currency bonds for maturity N for country H at time t plus 1. You notice that the expectation is actually time varying. And this is a function of 2 components. One is lambda t, which labeled the price of active fund risk, again, is time varying. And also we have a quantity of active fund risk, or risk exposure if you wish, which is beta HTA. So this is an interesting kind of representation, pretty conventional in the literature of asset pricing. The only thing that I would like to highlight is the fact that given that there are time variations in both the price of risk and the quantity of risk, we are in the domain of a conditional asset pricing model rather than the conventional unconditional asset pricing model settings. So to give you a little bit more intuition, let me try to rewrite the formula I saw before in terms of unconditional average expected returns adjusted for market risk. So you can see that if you use Jack and Nathan 1 decomposition, we can basically rewrite those returns as comprising 2 different components. The first one is essentially the conventional unconditional asset pricing effect In other words, expected returns are a function of the average price of risk and the average quantity of risk. Plus, there is another component that you can see here in equation 2, comprising two elements. One parameter, which is phi(n), which we call beta premium sensitivity, that captures the co-movement between the price and quantity of risk over time. And then the variability of the price of risk associated with the active fund. So you can see one important finding here. So the last component is the one that basically generates the time variation in expected returns. And what you see here is when the phi(n), which is the beta premium sensitivity, is positive and statistically significant, the larger is the variability of the price of risk, the larger are expected returns associated with the specific asset. So we are trying to test all these hypotheses specifically in our model in order to test whether it is the case for local currency bonds. So I won't spend too many details in indicating the estimation strategies. If there are any questions, I'm happy to address them during the Q&A session later on. But just for the sake of providing you with some details, what we do, we adopt a procedure in order to estimate time-varying betas, the quantities of risk, and lambda, using the procedure suggested by Pektova and Zhang in a paper in 2005 Journal of Financial Economics. In a nutshell, what they do is to postulate a sort of linear relationship between these two quantities, betas and lambda, and some specific conditioning variables. In the context of betas, we are looking at variables which are associated with the slope and the level of the yield curve in individual countries, while for the context of lambda, we use the theoretical rationale and use the fund flows from and to emerging economies as this conditioning variable. So another thing we do is to basically strengthen the signal, because you will see we're going to use a sample of 16 emerging economies. And in order to get a stronger signal, we basically create a sort of portfolio formation technique in order to basically isolate a stronger effect for the asset pricing effect that I mentioned before. So essentially what we do every month, given that we have a cross-section of betas that is all estimated, we basically construct two portfolio. One is portfolio H for high, another one is portfolio L for low. The portfolio high contains the bonds in the top tercile of beta estimates, the one with the very large exposure to active fund risk, and portfolio low comprise bond in the bottom tercile of the beta estimates, the one that have the least exposure to active fund risk. We do this kind of exercise on a monthly basis. We keep the composition of the portfolio constant and then rebalance it again, computing returns. So just for providing you additional information in carrying out the empirical exercise, we basically look at conventional data sources for essentially our yields are computed using data from Bloomberg, to which we have applied Nelson-Sigget technology for maturities 1 to 5 years, which are pretty conventional in the term structure literature research. We compute excess holding period returns in dollars using the prevailing bilateral US dollar exchange rate, again from Bloomberg. In terms of fund flows, we use the information provided by the dataset ABFER, where we have a specific characterization of the flows, especially in the sovereign domain, to and from the emerging economies in our sample. And then in order to proxy for market risk and active fund risk, we use two different portfolios. One is a total return on a global treasury fund in US dollar, and the other one on emerging market treasury fund index in US dollar, both of them from JP Morgan. The countries we are looking at are 16, comprising emerging economies of Asia, Latin America, Eastern Europe, and the sample period used in this presentation ranges between June 2007 and March 2018 for a sample of more than 10,000 months. So without any further ado, let me try to spend time on the results that we obtain in order to show you the main, I would say, calculations and the main result for the hypothesis we have mentioned at the beginning. So you can see here we have two panels in this slide. The upper panel is looking at the estimate of betas for the portfolio H and the portfolio low for different maturities ranging between 1 year and 5 years. The maturities there in month. And you can see that the first finding is pretty obvious. There is a very clear evidence of heterogeneity of exposure against the active fund risk. The beta I are always statistically significantly higher than the one exhibited by the beta low for all maturities. And if you remember what the condition was mentioned as an implication of the asset pricing model, the assets or the bonds they experience a larger exposure to this active fund risk will have to have on average a higher excess return, which is indeed what we find in the lower panel, where you can see that for all maturities, the expected returns adjusted for market risk in US dollar are all higher for portfolio H in comparison with portfolio L, and they're all statistically significant at 1% level. So one thing to provide you with additional color is if you are interested, or if you were wondering what are the countries or what are the characteristics of the countries whose bonds are included in this portfolio H and low, we have essentially computed an average for different relevant macroeconomic fundamentals. We look at the current account, we look at foreign reserves, and also the US dollar foreign exchange. And you can see that the ones with portfolio H, they tend to have weaker fundamentals in that the countries included in portfolio H experience current account deficits. They hold less foreign reserves, and their foreign exchange rates depreciate significantly against the US dollar, especially if you look in comparison with portfolio L. And all these differences, again, are statistically significant at 1%. So that point out that the countries whose bonds are included in portfolio H tend to be more fragile, I would say, or with weaker fundamentals. The second finding I want to show you first from a qualitative point of view, and later I will give you some more detail quantitatively, is that when we actually correlate the dynamic of bond outflows from emerging economies and the estimates of our lambda T, which is the price of active fund risk, there is a positive correlation between the two, as postulated, similarly to what is postulated in the theoretical work of Vallanos and Woolley. So if you want to have a general understanding of what back of the envelope calculation will give us, $1 billion net outflows from emerging economies will increase the price of active fund risk by 25 basis points per month. So let me show you quickly a graph that basically is reporting two different plots. The black one is the estimate of the time-varying lambda, and you can see that it's certainly changing over time with several spikes. Some of those can be easily associated with situations where there are large outflows from emerging economies, notably the taper tantrum in the middle of 2013, but there are many other cases here pointed out. And the other one is the behavior of the VIX. I won't spend too much time on the comparison between the two because very likely there may be some questions later on either from the discussants or from the audience. So I will continue showing you an additional set of results and then wrapping up the presentation with the last slide. So what I want to show you here is the second set of estimations that aim at quantifying the extent of beta premium sensitivities. If you remember, the beta premium sensitivities are this parameter phi, which are normally associated with the covariation between the price of risk and the quantity of active fund risk. So you can see here that for most of the maturities, with the exception of the 5 years, we see that the parameter phi H is positive, statistically significant, and certainly larger than the one associated with the same maturity for portfolio L. So what is the implication of this? If you remember from our theoretical setup, it will tell us that given that the value of the parameter phi is positive, a variation in the price of active fund risk will imply that there will be even a higher impact on conditional and then unconditional, obviously, expected returns for these bonds included in portfolio H. In other words, there will be a reinforcing effect, generating a sort of double whammy effect, if you want, where when the quantity of risk increases, even the price of risk increases and therefore generates an even stronger effect for the asset in questions. So let me try to wrap up this presentation. Hopefully, I have done it within the stated time. The main takeaways that I would like to highlight is that in our research, we've simply estimated a variant, I would say, a variation of the model proposed by Vallanos and Wool in 2013, and we find that bonds whose return are positively correlated with the returns of foreign investor portfolios exhibit higher average returns adjusted for market risk. And we take that as a compensation as evidence of compensation for active fund risk. Bonds with higher average returns are issued by countries with relatively weaker fundamentals. Portfolio outflows from the emerging economies positively impact the price of active fund risk. And we find that these are very interesting results, that bonds with high average excess returns exhibit a higher exposure or higher quantity to active fund risk when the price of risk is also high. So I will stop my presentation now and leave the floor to the discussant. Thank you.
Okay, thank you, Giorgio. So very clear presentation. And now I'd like to ask Anella Munro, who's at HS Group Business, to discuss the paper. Anella, the floor is yours.
Thank you, Iliok. So thank you very much to the organizers for the opportunity to discuss this paper. And it is a real pleasure to have a whole series of sessions in the Asian time zone. There are a lot of things that happen around midnight our time, and it's great to have this conference. So for me, just fairly standard sort of discussion, what the paper does, and then a few comments, probably one too many in there. So what does the paper do? I think it asks, can we explain the cross-section of local currency bond returns in emerging markets? And the answer is, in a sort of spirit of Fama in French, yes, by understanding risk. So they look at 16 emerging economy sovereign bond excess returns, regress those on a EM global spread. I'm going to call it an EM global spread. One thing I'm going to have a bit of a moan about is the connection with active fund risk. So, and while I'm here, can I also have a little bit of a moan about Hong Kong and Singapore being emerging economies? And then a robustness question would be, how much does that affect your results? And as Giorgio said, the more exposed bonds tend to be from countries with current account deficits and low reserves. Then they sort bonds into portfolios based on their betas, and higher beta bonds have higher average returns. So indeed, this does look like risk. And this is a common strategy because bond excess returns are really volatile. So if you group them into portfolios, you get something a little bit more manageable in terms of dimensionality and noise. Then they regress the excess returns on previous periods' aggregate outflows. And the fitted component of that is time-varying outflow-related premium. And then they regress the portfolio betas, which is the average of the bonds in the portfolio, on that outflow premium, and indeed find that what Giorgio called a double whammy. High beta portfolios are more sensitive to outflow risks when the price of risk is high. Let's go through here. So yeah, there's lots to like about this paper. They look at sovereign bonds both across countries and maturities. It's a nice, clear presentation. There's some really interesting results. I think the connection between outflows and foreign investor returns and premiums, finding that connection is something that is quite important in our understanding of how they all work with each other. The term structure of returns is not monotonic. and it affects intermediate maturities most. I think that's actually a really interesting result. I'll come back to that a little bit later as to why. And yeah, this is an important question, the performance of local currency bonds, and it relates to a lot of the discussions in the previous session, earlier this morning, for some of you yesterday, the whole question of, we avoid original sin by borrowing in local rather than foreign currency, but then we still end up with issues because of the riskiness of those bonds, and they're treated like risky assets. So they ask, how can we understand these exposures, and what does it say about policy? More local savings, but I guess as Linda said this morning, that's kind of a bit of a difficult one, because people are borrowing exactly maybe because they don't have enough savings. Good macro fundamentals, and can foreign investors hedge the FX risk? So my comments, one is kind of, what's the benchmark in terms of, should we think of this as amplification, or should we think of these outflows as a normal part of the benchmark model, in a sort of full information, full foresight model? And it depends what your model is, right? As to these outflows, should I think of passive investors as being an attenuating force and a step away from the rational model, whereas these outflows and active investors are the kind of rational investor in the model? So should I think of this as amplification, or should I think of it as normal and the passive is attenuating? And a model that I like to think of that I find quite useful is the Causality et al. Model, with the idea that some countries are more exposed to global risk. And so ex ante, those countries are more risky because they have the undiversifiable risk. So they have a higher precautionary savings motive, they have lower interest rates, and in good times, capital flows out of the center to the periphery, which is less exposed to global risk. And then in bad times, when global risk manifests, capital flows back to the center. So it's sort of a risk-sharing story. The periphery, ex ante, is not exposed to global risk, but with this, they get lower interest rates in good times, but they suffer outflows in bad times. So they're now starting to share global risk. So if I think of that model, these outflows and exchange rate depreciation and higher premia are all kind of part of the benchmark model in my sense. So that's what I mean by, is this and this correlation between them a normal part of the model? I struggled a bit with the active fund risk, and I wonder if that's really what you want to call it. Outflow risk, maybe, because I think you connect it really to outflows, to that aggregate outflows. Should we think of these things as all different sides of the same coin? When capital flows out, exchange rates depreciate, premiums go up. Have you really convinced that there's kind of a notion of causality in there, and I'm not really sure if it's all caused by the manifestation of a global event that causes all of them. If there's persistence in that global event, then you could pick up causality where there isn't any. And I know you say in the paper, and you said in your presentation, we're not looking at currency returns in this one, but it's irresistible because it really is quite close to the whole literature on the cross-section of currency returns. And all of the factors that are considered in there, how close is this to those? If I think of the local currency bond returns in US dollars that you're dealing with, those are local currency returns in local currency plus a currency return. So part of what you're talking about is a currency return. It's really hard to get away from that. So I wonder whether you could at least discuss it to give some flavor to it rather than avoiding it altogether, which might just keep coming back. The potential criticism, is this just all currency returns? Should you really be writing a paper on currency returns? I don't think so, because you get that difference across maturities. And so I think there's something else going on here. But if you could, maybe in a robustness check you could even split the two. And then just coming back to policy, partly related to this paper, but again, it relates to a lot of the discussion this morning, both in the first paper and in Chang and Shengjin's paper. So, we used to have original sin, then the answer was, well, if you can borrow in local currency, that gets over the problem. And Asia's done incredibly well in terms of sovereign debt, not so well with corporate debt. But the message is increasingly this is not a panacea, because for non-residents, now they hold the FX revaluation risk, they treat local currency debt as risky assets, and they run in bad times, creating exactly the kind of dynamics that you're getting at. And so your suggestions for policy, resident savings, and resident savings is a great one if you can make it happen, and pension funds and things are good, maybe good ways to do that. It doesn't matter whether it's local or foreign currency, because foreign currency repatriation is great in bad times too. Better macro fundamentals and hedging. But one that maybe hasn't been discussed so much is liquidity risk remains, right? Whatever, and in fact, liquidity risk maybe is worse because it's being treated as a risky asset because of the FX revaluation risk. People are more likely to run. So then the policy prescription has to be really set yourself up to manage liquidity risk, right? So you have your domestic lender of last resort, make sure you can take a lot of things as collateral, make sure that's working well, encourage your banks to have stable funding, along with the Basel III and so on. And again, that Colacito and Croce, it's Colacito et al. Paper, really the message of that is these flows go and they come back with global risk, and there's this ebb and flow, and you've really got to set yourself up to manage liquidity risk. But in that risk sharing model, I think there's also a more fundamental question. Is the emerging economy in a position to share that global risk? Do they have the balance sheet strength and financial structure? And that kind of comes back to the sort of issues in Chang and Shengjin's paper. So open in a commensurate way, and the whole IMF move towards capital controls maybe being okay. So yeah, I really like this paper. It's an important question. Really nice empirical strategy and presentation, nice exposition of this link. And often in macro, we don't really get at flows, we deal more in prices. So I thought that was nice. And yeah, connecting those flows and prices and so on. My main question is it really motivated by the right theory, right? Or is it the right underlying model of this active? I struggled with that one. So, but my job as a discussant is to be grumpy in all the ways that an editor might be before you get a chance for the editor to be grumpy. So, yeah, thank you. I enjoyed the paper.
Okay, thank you, Anella. So I'd like to ask Giorgio to react, but before that, I'd like to also ask the participants to send your questions either by chat function or the Q&A function, so that the organizers can take a look, and then I will ask those people who ask questions to post the question after Giorgio reacts. Okay, Giorgio, please.
Okay, thank you very much, Anella, for the very nice discussion. You haven't been too grumpy, I would say. So everything you mentioned makes perfect sense, and somehow you have anticipated some of the things that I would have said at the end of the presentation if I had time to actually go through robustness. But nevertheless, let me try to address some, if not all, of the points that you made. You started mentioning the issue of for example, why do we consider the panel of countries that we are considering, especially with the inclusion of Hong Kong and Singapore? One of the simple reasons is we started initially this project as an assignment for a BAS conference back in 2018, and we decided to stick with the definition that BAS used for emerging economies. They indeed include Hong Kong and Singapore. Just to reassure you, if you remove Hong Kong and Singapore for the sample, the results are not changing dramatically. We had this kind of conversation with Jason and Inhwan, but we said, okay, we keep them in order to be consistent with the initial list. But if those two are certainly not part of the usual suspects, I would say. But let's go back to other point that you made, in my opinion, that were very interesting about active risk, the notion of active risk. Active fund risk, it is an interesting way. We found it fascinating because the reason why we are sticking with Vajanos and Woolley, and we agree with you, there is a very large literature that originated from Vajanos and Woolley, and they actually went into different directions. Sometimes they actually obtained similar kind of parametric form from a completely different starting point. They generated what we now call like institutional asset pricing literature, where people are looking at the behavior of institutional investors in order to draw some implication for the definition of asset prices. And the reason why we liked it is just because although we can get to the same point from different directions, one of the things that, in our opinion, give a sort of additional edge to the Vajanos and Woolley model is the natural conditional nature of the model. So the fact that flows do enter directly. We do appreciate that this is a partial equilibrium model. So we know that there is no general equilibrium effect. We know that the exchange rates are important. I'll get back to that point in a minute. And we know that they are important. But just for the sake of having a simple preliminary set of stylized facts, I think this is a very interesting starting point, because we simply amend the model by assuming a very mild set of assumptions to start from a closed economy structure like the one in Vajanos and Woolley and get into the one that we have applied to local currency bond returns. This, I think, is an interesting way of looking at the problem. Whether or not this is an exhaustive way of looking at the problem, that's actually a fundamental question. And I agree with you, this is probably not. I think if you want to have a good description of what's going on in the real world, I think a dynamic of the exchange rate has to be in there, and perhaps there must be a sort of general equilibrium structure that can inform the way asset prices are determined. Just to follow up on looking at more recent contributions, I think Matteo Maggiori's recent paper is also an interesting kind of example where he's also looking at the exchange rate variation and the balance sheets of financial intermediaries, where you have indeed some information coming in, also affecting the dynamic of UIP, going back to the traditional, I would say, international macro literature. But I agree with you. This is something important, but we take this kind of empirical investigation as a sort of phase one. If you wish, try to understand a little bit more whether or not there are some implications, assuming that we start from a very set of stylized kind of starting points in a partial equilibrium setting. The Colacito et al. Model that you are referring is indeed a very good benchmark. I just want to tell you that there is a follow-up paper that I'm working with Peter Hordal at BIS, and we are looking at the dynamic of bond returns and capital flows, specifically bond flows. And we do find some sort of similarities, but also differences, because in that paper, which is still we are writing, so it's not really public yet. So we do actually make a sort of horse race comparison. And when you're looking individually at the flows from sovereign and the behavior of excess returns, you do find that the effect that we are having from flows is actually going beyond what they indeed found in the context of the Colacito et al. global imbalances. Causality. Causality is a big thing. Obviously, testing causality in asset pricing, I think, is more or less like a holy grail. So you want to make sure that there is indeed such an effect. We are not addressing it here. I have to be 100% honest. We are just taking the implications from the Vajanos and Woolley model at face value. So it will be obviously very important to have an exogenous shock where I can indeed isolate the effect that they may come exogenously from outside the model and see whether this kind of implication for the asset prices actually stands strong. It's something that can be considered if I just fast forward, for example, to what we are doing in terms of robustness, moving to a longer sample period and using more granular data at the weekly level. So with this kind of expanded data set that we're working on with Jason, is indeed some of the results, actually most of the results are indeed confirmed, even if we are looking at a more granular level. But we are in a condition potentially to test for such an event in case the event is within the sample period. Okay, looking at the foreign exchange returns, I'm with you. It would be nice, and probably something that we are considering now in the revised version of the paper, to actually split the effect that comes purely from local currency and the one that comes from exchange rates. We haven't done it yet, but it's something that we are certainly considering. One other thing that we are considering at the same time is to reverse the argument essentially on its head and trying to see what is the implication, for example, of having a structure with two factors where you have this active fund risk in place for example, the validity of UIP. Given that there is a recent paper by Anna Lustig and co-authors in AER where he's looking at bond-based UIP strategies. And given the specific setting, we can use the theoretical results we have in our model in order to see what the implications are for UIP. And this is something that we're trying to actually connect analytically and see whether there are some interesting implications. So if I may allow myself just 1 minute more to go on the policy part, which obviously very important to us. The liquidity risk is an aspect that is certainly important and worthwhile investigating. One of the things that we see in our model, because when we discuss the findings, it's important to take into account the potential policy implication as spillovers for the development of such markets. Because liquidity is one of the arguments which are important. Would liquidity risk, for example, amplify or dampen the effect that we are actually experiencing? So if markets are more integrated or less integrated, would that imply a larger, spike in variation of price of risk or the market or the quantity of risk? And would there be implications also for, not only the issuance from emerging economies, but also for investors locally and also from abroad? So those are all questions that are all related to the same framework. We haven't addressed them thoroughly in this draft. We're planning to look at it later on.
Okay, thank you, Giorgio. And let me see if there's any question from the floor. Looks like there's none at the moment. So in the meantime, maybe I'll ask you a question, and thank you for citing my paper. So I already wanted to mention our exchange rate, other effects. And one important question I have is you are sort of using this biannual only active funds, but then the way you're doing IMPICS is using this index. And of course, you explained that it's difficult to have a fund by fund, but I think there is sort of a way if you go to more granular ones, EPFR or other data sources, you can choose funds, they report funds, country level investment, you can take out exchange rate effect, bond price effect, and you can actually have the fund by fund, month by month, country by country, net purchase and sale of bonds. Like you can use those data to actually see the true active fund behavior, because active fund by definition should not follow index. So I think that's sort of this bit conflicts in terms of the concept, I think. Yep. Yeah. And in terms of I actually found interesting this in-body U effect. So 5 year, actually 5 years is a very popular tenure maturity for foreign investors, because you can calculate the duration is typically 5 to 7, 8 years for EM. So I was sort of wondering why only 5 years is not significant, but up to 3 and 4 years it looks fine. So is there any sort of more intuitive reason for that?
Okay, so thank you, Iliop, for the suggestions. We already thought, because obviously we're well aware of the stream of work that you've been doing. And with Jason, we have carried out already the analysis at the fund level. So in the revision of the paper, we are using weekly data where everything has been calculated from the ground up from each individual funds. So we're looking at funds which are labeled active by definition. And then we also get the fund flows from those funds. And therefore, there is no, I would say, mismatch between the theory and the empirics. The results are all confirmed analytically, so we're happy to report that, even in the new version, we're going to have the same effect that you have seen at the monthly level. Regarding the 5 years, the 5 years is a little bit an issue. Initially, let me tell you what the take was and then what the situation is. So the take initially was looking at a paper written by myself, Eli Remolona, and Peter Hordel, where we were looking at potential effects at the very high frequency of macroeconomic news. Even there, we actually found that there was a sort of hump-shaped behavior. So even in the way different kind of maturity responded to macroeconomic news, it wasn't uniform. It was actually hump-shaped, and the hump had an apex at the 3-year level. So we thought it could be rationalized that way. But my feeling, looking at the new data over a longer period of time and different granularity, is very likely to be an artifact of the data and the sample period. So I want to make sure that in the new version, we're going to go through a battery or robustness test to make sure that either is really a 5-year effect or is just an artifact of the data, and therefore we might actually restore the significance of the 5-year in the same way like the other maturities are.
Okay, thank you so much. I think this is a perfect timing to finish the first paper. So thank you again, Giorgio and Anella, for your excellent presentation and discussion.